Buying a house is a life-changing moment. It could be the biggest investment you make. It all starts with saving for the deposit. Finding out how much you'll need to save for your deposit and putting a savings plan in place is the first step on the road to home ownership. Before you start building a deposit, use the Tella affordability calculator to work out how far your income will take you and what size loan you can afford to service. You'll find a link to this on our website below this video. This will help you with putting a savings plan together, allowing you to think about what locations work for your price range and how far off your new home you are in terms of a time frame. Putting together your deposit. There are a number of ways you can piece together a deposit. Check out our guides and videos on KiwiSaver, Kainga Ora, and Buying with Help. Cash savings. The main and most important contributor to your deposit are cash savings. This is income put aside over a period of time. KiwiSaver. It's possible to withdraw most of your KiwiSaver savings as long as you are using it for the purchase of your first home. Kainga Ora. The government offers both a first home loan and a first home grant by way of its social housing agency, Kainga Ora. Family loan or gift. Family assistance, often in the form of a loan or a gift. How much should you aim to save for a house deposit? Some lenders only require a 5% deposit for first home buyers, but it's important to note that this comes with conditions to be met, and it's more common today to expect that the minimum first home deposit to be at least 10%. It's also important to understand that if your loan is over 80% lending, it is likely you'll be charged a higher interest rate or a fee. Why will a larger deposit save you money? A bigger deposit means that you won't need to borrow as much to purchase your house, which means you will have less interest costs than if you had a smaller deposit. A bigger deposit also shows lenders you're a good saver and that you're able to manage your finances. This can increase your chances of getting approved for a home loan. What is loan to value ratio? The bigger your deposit, the lower your loan to value ratio, LVR. Your LVR is the amount of loan divided by the purchase price, or appraised value of the property. For example, if you're buying a property at $600,000 and you have a $450,000 loan, your LVR would be 75%. Low equity margins or premium. If your LVR is above 80%, you usually have to pay a low equity margin in addition to the standard interest rate. This will remain in place as long as you're borrowing more than 80% of the value of the property. It can be removed either when you repay enough of the loan to be below 80% LVR or the value of the property has risen. A low equity premium is a little bit different. The lender will charge that and add it onto your loan amount. Start saving for your house deposit early. Now that you have a good idea of how much you need for a deposit, put a savings plan in place. If you're buying a house with someone else, make this plan together. The sooner you start, the better. Banks take into consideration spending behaviour and like to see a reflection of your credit character represented in your spending history. So consider how you spend as well as how you save. How long does it take to save for a house deposit? Saving for a house deposit does take time, and it's important to be realistic about how long it may take. The amount you will need will depend on the housing prices in your area you want to buy. Remember, you're saving for one of the largest purchases you'll ever make, so having a good savings plan and sticking to it will help you reach your goal sooner. Preparing a budget. Preparing a budget sets the scene for what's affordable, what personal changes you may need to make around spending and saving, and how long it will take you to achieve the savings goal. If you're planning to buy a house with a partner, doing this together is important. Prepare a budget so you can see what money is coming in and going out of your account each month, how much you can afford to save each payday, what spending you could cut back on to increase your savings. Automate your savings. Consider setting up an automatic payment from your account that your wages go into to a savings account each payday, or ask your employer if they can send part of your pay directly into a savings account. Automatic transfers let you set and forget, so you can grow your savings without having to worry about transferring money each payday.